Hi everyone, welcome to the channel. If you are preparing for a financial analyst role, you are in the right place. In this video, we'll go over the top 10 financial analyst interview questions and I will explain each one in the simplest way possible. Just clear and easy to understand answers that will help you to build a confidence. So let's start with the first question. First question is, what is finance? So answer will be, finance is simply the management of money. It involves how individuals, business, or government earn money, spend it, and invest it, and save. In a business, finance is about planning how to use money to run operations, expand, pay off debts, and more. If you think about your own budget at home, how much you earn, how much you spend, and how much you save, that's the finance at personal level. So the next question is, what is cash flow statement? A cash flow statement shows where a company's money is coming from and where it's going. It's like a bank statement. It tells you how much cash a company received and spent during a period. It has three parts. So first is operating activities, investing activities, and financing activities. In operating activities, it includes day-to-day business. Like if in a manufacturing company, there will be a manufacturing is the operations. So operating activity is the manufacturing. Then investing, like buying and selling of an asset. Financing is like loans and dividends. The third question will be, what is WACC? WACC stands for Weighted Average Cost of Capital. This just means the average cost of raising money through loans and shares. For example, if a company borrows money from the bank or sell part of itself to investor, there is a cost involved, either the interest or giving up ownership. WACC shows how expensive it is for the company to get that money. It's important because a company should only invest in projects that earn more than the WACC. The fourth question is dividend growth model. It is the model which is used to value a company's stock based on its future dividend. If a company pays regular dividends and they grow every year, the model helps us to understand or to estimate how much the stock is worth today. Think of it like this. If you are promised rupees 10 every year and that amount grows 5% every year, how much would you pay today? Get that income. So that is the dividend growth model. The fifth question is, what is deferred tax liability? A deferred tax liability is a tax that company owns but haven't paid yet. It happens because companies use different accounting rules for taxation and financial reporting. For example, a company might write off an expense faster in tax books than in financial books. So the company pays less tax today, but it will owe more tax later. That future tax is deferred tax liability. Okay, let's go to the sixth question. What is EBITDA? EBITDA means earnings before interest, taxes, depreciations, and amortization. Basically, it tells us how much profit a company makes from its main business before any other costs are subtracted. It removes items like taxes or interest payments to give clearer picture of a business performance. Let's come to the question number 7. What is working capital? Working capital is a money a company has to run its daily operation. It is calculated as current asset minus current liabilities. For example, if a company has rupees 1 lakh in cash and inventory but owes 70,000 in bill, that will be the liability. Then how much will be the capital? Working capital. Working capital is equal to 1 lakh minus 70,000, then it will be the 30,000. So positive working capital means a company can pay its short-term liabilities, while negative means that it is a trouble for a company. Okay, let's come to the question number 8. What is sensitivity analysis? So answer will be, sensitivity analysis checks how changing one thing in a financial model affects the final result. For example, what happens if sale increases by 10% or if interest rate goes up? This helps businesses or analysts to prepare for best case, worst case, and most likely situations. It's like stress testing your assumptions. So the question number 9 is, what is a DCF model? DCF model is a method used to estimate how much company is worth today based on the future money it might make. It takes those future cash flows and discounts them to take today's value. Because money now is worth more than the money later. If a value is higher than the company's current price, it might be a good investment. The last question is, what is common sizes statement? So answer will be, a common sizes statement is just a percentage version of the financial statements, every line item is shown as a percentage of total revenue. So instead of saying we spent 50,000 on marketing, it says 10% of revenue went to the marketing. This helps you to compare different companies even if one is big and other is small. So this is it. I hope these questions are very helpful for you. If you are preparing for interviews, rewatch this, take notes and practice explaining these in your own words. Don't forget to like, share and subscribe to the channel. Thank you so much, and thank you so much for watching, and happy and good luck for your interview.